Welcome to Accounting Fundamentals, Session 1. Constructing a balance sheet. In this session, we have several objectives. The first one is explain the format and layout of the balance sheet. Before that, I will explain the three financial statements. The first one is balance sheet. The balance sheet shows what a company owns, referred to as its assets, what it owes, referred to as its liabilities, and what it's worth, referred to as equity, at a particular point of time. The next one is income statement. Income statement, also known as statement of profit and loss or statement of operations, shows what a company has earned as revenue, what it has paid as expenses, and what the resulting profit or loss. The third one is statement of cash flow. It shows the actual cash movement of a business and how much cash the company has brought in and how much it has paid out. It organized into three categories: cash from operating activities, cash from investing activities, and cash from financing activities. In this module, we are going to focus on balance sheet in more detail. Let's begin with the asset side of the balance sheet. Assets are things that a company owns. This includes cash in the bank, furniture and equipment, and technology that used to create goods or services. Assets are organized into two groups. The first is current assets. Current assets are assets that are expected to be used within 1 year's time. They include things like cash, inventory, and accounts receivables. The second category is non-current asset. Non-current assets are expected to be last more than a year's time and include things like property, plant and equipment, technology, patents, trademarks, etc. Non-current assets are typically grouped into two categories: tangible and intangible assets. Tangible means being those that are physically like property, plant, and equipment. The intangible being those like patents and trademarks that are not physical. By totaling the current assets and non-current assets, we arrive at the total assets at the business. This forms the left side of the balance sheet, which must equal the right side of the balance sheet. Moving on to the right side of the balance sheet, we have two categories: liability and shareholders equity. Those liabilities are broken down into current liability and non-current liability. Current liabilities means those that are due in more than a year's time. Current liabilities typically includes accounts payable, which is the amount owed to suppliers. Whenever a company purchases something on credit, it results in accounts payable. Most suppliers provide anywhere from 30 to 90 days as their terms for payment. So, company will have an account balance that is expected to be paid off typically within 30 to 90 days. On the non-current liability side, things like long-term debt which would be any loan that's due in more than a year's time, are recorded here under non-current liabilities. By adding together all of the company's current liability and all of its non-current liabilities, we arrive at the total liability line on the balance sheet. The next one is shareholders equity. The shareholders equity section is what the business is worth after all the liabilities have been paid off. At the beginning of a business, the shareholders equity is equal to the amount that's initially invested in the company. That is referred to as shared capital. The investors get common shares in exchange for providing money or capital to the business. Then over time, the balance can go up or down as the company either earns profit or losses. If the company produces a profit, that net income flows into shareholders' equity as retained earnings. Those earnings can be retained and remain on the balance sheet, or they can be paid out in the form of dividends, which reduces retained earnings. If losses generated, those also reduces the retained earnings account. So, retained earnings is essentially a running total that shows how much profit the company has generated, less any losses and less any dividends that have been paid off. At the end of the day, the total shareholders' equity value must be equal to the total assets minus total liabilities. The final step in the construction of a balance sheet is balancing. We are about to start a balance sheet, but first it's important to flag that a balance sheet must be always balances. What that means is that the total asset side of the balance sheet is always going to be equal to the total liabilities and total shareholders' equity side of the balance sheet. In order to make sure that's the case, accountants have developed a system of recording transactions on two separate places. This is what's known as double entry accounting. This ensures that the balance sheet is always working. There are two options for doing this. The first option is to record the transactions on both sides of the balance sheet. For example, if a company uses cash to pay down debt, the asset side of the balance sheet goes down on the cash balance, and the liability side of the debt owed also goes down by the same amount, so the balance sheet still balances. Other option is to record a transaction twice on the same side. What that means is, if this time a company uses cash to buy an asset, we record it twice on the asset side. Cash goes down as an asset, but whatever is purchased makes the asset go up. So cash goes down and the property, plant and equipment goes up, and the balance sheet still balances.